Hello and welcome back to Instant Insights. At Global Data's Thematic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Carolina Pinto, and today I'd love to welcome back Rory Green, Head of China and Asia Research at TS Lombard. Rory, how are you?
I'm great, thanks, Carolina. Great to be back.
Thank you for coming back. I wanted to have you back on the podcast because a couple of weeks ago, I heard your webinar that you did about China's role in the global economy. And in it, you spoke about China's shift from a property-led economic model to one more heavily focused on tech investment and China's general dominance of global markets. Now, we've already covered this on the podcast before with you, but I found it interesting that in the webinar, you warned that this shift in economic model, combined with a lot of the systemic issues in China's domestic market, including, debt and demand issue or consumer demand issues, could potentially cause China to fall into a decade of Japanification. Don't know if I'm saying that right.
Yeah, that's great.
Yeah. But what does this mean? What is Japanification? And what does that mean in this case study of China?
Yeah, really good question, Caroline. And just to clarify, sort of the economic transition, the new part of the economy is actually going very well. The tech side, the policy favored areas, that type of manufacturing is really booming in China. And the problems that come with Japanification is, as you said, the old issue, the debt and the decades of resource misallocation, which are still weighing on growth. And that new economic drivers are insufficient to offset. And what we talk about when we mean Japanification is it's really sort of shorthand for the pronounced slump in growth and inflation experienced by Japan from the 1990s pretty much to this year, to 2024. I mean, it is only this year that the Tokyo Stock Exchange topped its previous all-time high set in 1989. So this is a very much a pronounced, it was a deep slowdown. It is the subject of many academic papers, but to simplify, the basic cause was Japan grew very quickly through the 70s and 80s. Part of that growth was funded by relatively cheap lending and then investment. And increasingly, as Japan grew ever faster, those loans went into unproductive and more sort of speculative assets. So land, stocks, other stores of value started to increase in price very quickly as cheap money fueled these valuations. Mm-hmm. And by the late 80s, they were very much into bubble territory. And to give you some idea of how big this bubble was, there are all sorts of ridiculous statistics about the valuations, but my favorite is that at the time, the Imperial Palace in Tokyo, so about 3 square kilometers, it's a pretty small chunk of land, was worth more than the entire state of California. Just to give you an idea of how much, how big the bubble was. It was enormous. And it eventually popped in 1989, partly due to tightening from the Bank of Japan. And what happened then was that all those assets that had gone up very rapidly in value collapsed. But the debt that was used to buy them stayed the same. So effectively, the whole economy went into negative equity. It's a bit like, you say you borrow $300,000 to buy a house. The value of that house decreases almost immediately after you buy it. You still have the loan left and you have to pay that back. So the entire economy effectively went into negative equity and entered what economists call a balance sheet recession. So households, corporates, the banks who made these loans to buy stock, housing, unproductive assets, all entered negative equity. And that meant that they had a very prolonged period of balance sheet repair, high savings rate to try and pay back all of those loans, which had been used to buy what was now effectively almost worthless assets. And if most of the economy is saving, there is insufficient consumption or investment, and that means an economy will slow and eventually shrink. And we think China is at risk of a similar Japanification. There are quite similar characteristics in terms of the type of growth, very much investment-led, property-led, and the high levels of debt. It's not exactly the same, but there are enough similarities for us to be quite concerned.
But I can't say that I was alive for much of the 90s, but compared to Japan in the 90s, from my understanding, China is a much bigger player on the global scale today than Japan was at the time. It dominates in pretty much most supply chains, in raw materials to manufacturing to end product. So how likely is, if China isn't in the same position as Japan was, then how likely is this Japanification to happen? And if so, would it be as bad or as long as Japan's was?
Yeah, really good point. And we think it hinges on two key factors. Essentially, how much Chinese government is willing to borrow and spend, and how much the rest of the world is still willing to accept Chinese exports. Now, to explain this, if we turn back to the concept of a balance sheet recession, we can basically split the economy into four parts: the household side, the business side, government, and then foreign sector and rest of the world together. So if in a balance sheet recession, and we see signs of this now in China, as well as Japan in the 90s, households and businesses are saving too much, then it is up to the other parts of the economy, the government and the foreign sector, to borrow and spend or to export to offset that high savings rate. And if we look at past cases like Japan or perhaps Europe after 2008, where Tokyo and Berlin effectively went wrong is that the government was unwilling to borrow and to spend. They didn't create sufficient fiscal spending, sufficient demand to offset that high savings rates from households and businesses. And on the foreign side, if we look to Japan in the 90s, you're right to point out China is much more competitive than Japan in the 90s. And actually part of Japan's problem, it was that it couldn't use exports as a way to escape the balance sheet recession because China, Korea were far too competitive at that time, and Japan was actually losing market share at the same time as it entered a balance sheet recession. So again, take it back to the present day. It's going to mean rely on Beijing spending a lot and China maintaining access to foreign markets. I still think that Beijing will eventually come in to drive domestic demand and prevent a prolonged Japanification balance sheet recession type scenario. But I'm now actually a bit less confident than I was a year or so ago. They have not done very much in the past 12 to 24 months. I still think eventually they will. Xi Jinping is less economic focused, but there is a floor for growth, social stability, and in terms of China-US competition, there is a minimum level of GDP growth I think that China needs in able to compete and to prevent social unrest. We're probably getting quite close to that, and Xi will eventually have to step in and do the necessary stimulus that was not present in Japan in the 90s and enable China to just about escape from Japanification.
I think that makes sense. But to address the third thing you mentioned, which is the foreign demand, of course, it's become pretty clear that that foreign demand is probably not going to come from the US. But in the webinar, you did mention the importance of the EU and the importance of the Beijing versus Brussels relationship within the next 5 years in determining this foreign demand. Can you expand a little bit on that? What role does the EU play in China's growth plans?
Yeah, absolutely. And we touched on the sort of the two escape paths from Japanification, balance sheet recession. One is government spending, and the other is foreign demand. And actually, at the moment, China is relying more on foreign demand than government spending. So this is a really key part of current growth in China. And as you say, we think the Beijing-Brussels relationship is going to be really key over the next five years. As you noted, Carolina, the US market is increasingly closed to China. The rest of the world outside of the US and Europe, it's a big place, but in terms of market size, addressable export market, it is still relatively small. So China really needs access to Europe in terms of its ability to export and sell goods there as a means to offset that weak domestic demand. So that Beijing-Brussels relationship is absolutely crucial. And until the rest of the world grows sufficiently large in terms of market size to offset the US and Europe, then that is really going to be the hinge point for that second part of the escape route and China's ability to export its way out of a balance sheet recession.
Where do you think that the EU stands in this kind of chess game?
It is in some ways caught in the middle. It is an economy that is also export dependent and also has a massive reliance on China's market for final demand, particularly German companies. So this puts Europe in a difficult position. It faces rising competition from Chinese exports, particularly in advanced manufacturing, yet at the same time, it is also in part reliant on China for growth and reliant on the norms of global trade, of the WTO being maintained. At the moment, there is not really a coherent European policy on this. The Germans would actually like to stay open to China, whereas the French, the Spanish and the Italians, the French and the Italians in particular, would like to close access more quickly. And part of the reason driving that is you see far more BMWs in Beijing than you do Peugeots and Fiats. So it is really a question of market access and final demand. And I think this muddled response from Europe will continue. So it gives China an opening, and they can, I think, continue to rely on European demand for at least the next couple of years.
Yeah, I think the automotive sector is the biggest example of that. They're both relying, all of the Chinese EVs, BYD, etc., are all growing massively in Europe, but at the same time, the German automakers are reliant on Chinese market to both in development, in R&D, but also in sales.
Definitely. I heard a good one from apparently the German companies say they have to stay in China because it's like a health club. They have to work so hard to beat the competition, to stay ahead on innovation, that if they leave, they'll fall behind anyway. And I thought that was quite an interesting way of looking at it.
Yeah, absolutely. And then there's no short of Chinese investment in Europe for the automakers.
That's true, yeah.
Rory, thank you so much for joining me. I think this really cleared up the precarious situation that China's in. So yeah, thank you for joining me.
Thank you. It's been a pleasure.
Thank you, everyone at home, for listening from us at Thematic Intelligence. See you next time.